back to Lamb's Cryptoverse. Today, we're going to discuss the results of the FOMC meeting and what the heck happened with the market. Let me just refresh this. The Nasdaq was down 3.4%, and S&P was down 2.5%. But, and here's the strange thing, when the Fed increased rates and Jerome Powell started speaking, the market actually rose, including the Nasdaq. But somehow the Nasdaq went from being up, 0.5% to being down 3.4%. So what the heck happened? Well, first, let's go over what the Fed did. Today, the Fed, as you can see from the Wall Street Journal, the Fed raised rates yet again, yet again, 75 basis points. And they hinted at a small hike. This is according to the Wall Street Journal. So that sounds dovish to me. So let's compare the speed of interest rates hikes. And this is from Visual Capitalist. And it shows, and this is up to September, by the way, up until September, the Fed raised rates, maybe I'll make this larger for you, a total of 2.36 percentage points. That, my friends, is the largest Fed fund rate increase. And this is not like comparing percentages, because it was at zero. So if you go from 0.1% to 0.2%, that's a 100% rate cut. We're not talking about the rate rise. We're talking about absolute increases in rates. So forget about percentages. Make believe they're absolute increases. And if you do that, they went up 2.36%. And if you include today's rate increase, that would be over 3%. So that, my friends, is the quickest rate increase in history, which means that it's also perhaps the most tightness we've had, basically the most tightening of liquidity we've had perhaps in all of history, including the Volcker years of the late 1970s. So what's going on? Why did the market go down? Well, let's see what Jerome Powell had to say. First of all, I think he said something dovish in the beginning. He says, and I highlighted for you, in determining the pace of future increases to the target range, the committee will take into account the cumulative tightening of monetary policy. So by that he means he's going to take a wait and see. He's starting to take a wait and see approach, and then he mentions actually lags. So he's acknowledging that there is a lag between when he raises rates and what happens with the economy. And then he says the lags which monetary policy affects economic activity, inflation. So that's another issue. He not only acknowledged the lag of raising rates on the economy, but he's acknowledging the lag of raising rates versus incoming data, meaning inflation data, the PCE, because many of these talking heads have said that the Fed's not looking or not accounting for lags in a PCE, especially for housing inflation and rent. And so lags for the PCE and CPI. But the Fed in this sentence acknowledged that. So to me, this is a dovish move. And then at 2:41, the Fed said this, and I highlight it for you. I don't get any sense that we've over-tightened. So we'll move too fast. So here's where the Fed started to scare the market. Remember, the market rallied when the Fed raised rates. And beginning around this time, around 2:30, 2:45, Jerome started answering questions. And here's what he said. I don't get any sense the Fed is over-tightening or moving too fast. So this is the beginning where the market starts saying, wait a minute. The Fed seems hawkish, not dovish. And if you look at this one, even later in the day, it says here the market had initially rallied, but then I highlighted here, where did I say? The market had initially rallied, and then but by the end of Powell's conference, all the major indices, meaning equities, starting trading deep in the red because Powell indicated that risk to policy tightening were symmetric. So basically, what the Fed is saying is, maybe I should highlight this. You could probably see right here. It sounds like a lot like lift and hold. So basically, what happened was investors were looking for the word pivot, and the Fed saying, we're going to look at see what happens. To me, the Fed was dovish, but investors literally wanted to see the word dovish, and they weren't getting that, and that's what's scaring investors. So I'm not too worried. And by the way, rates, let's look at some rates here. Rates changed dramatically. As the Fed spoke, rates actually started going up. So they were down, and you could see them here. This is a one-day move. So let's look at the 5-year note. You could see it dipped right here. It dipped when the Fed raised rates, raised the Fed funds rates, and then it rallied. It went up, I should say. And you saw that the worst of it was in the 30-year and the 10-year. Well, the 30-year rate wasn't doing well all day. It was up all day, but you saw it in the 10-year and the 7-year, where let's focus on the 10-year. You saw the dip in interest rates as soon as the Fed funds rate went up. Again, as soon as the Fed funds rate went up, the 10-year rate dropped. But then as Jerome Powell ended his conference, as he spoke and answered questions, bond rates went up. But one thing I'm noticing is over the last few days, there's been a lot of inelasticity of bond rates. So what do I mean by that? The 30-year rate, except for today, the 30-year rate and the 10-year rate, they don't seem to want to go up much higher than they have been going up. Like the equity market, for example, was more fearful of rates going up than the bond market. And I think the bond market speaks the truth. And so the bond market, meaning the Treasury bond market, it's not showing indication of rates going up much more. So maybe they go up another 50 basis points going forward, but I can't see them going up another 100 basis points, 150 basis points. And actually the CME FedWatch tool, if you see here for 2023, this is a dot plot. It's showing that rates, these are the dots from FOMC committee members or participants, and you don't see them much higher than 5%. So I see a ceiling for 2023. And remember, this is all reflexive. And what do I mean by that? The Fed and the Fed governors, they're looking at the economic data points. They're looking at inflation. They're looking at the economy. They're looking at what's going on in emerging economies and developed economies. And we saw what happened in the UK, right? We almost had a pension crisis in the UK, and the Bank of England had to pivot. So the Fed is aware of that. So I think during the next few months, maybe we get another 50 basis points increase in the Fed fund rate, and that's because unemployment is still too low. And we saw the ADP numbers were very strong today. We had over 200,000 jobs created, according to the ADP. So I think the next employment report, next labor report is going to continue to be strong. So this is what I'm thinking we're going to get. Another 50 basis points rate hike in December, and then maybe 25 points increase, and then we're going to hold. And that's going to be your pivot, where the Fed holds instead of lowering rates. And the Fed's going to hold until something breaks. So I hope this was useful to you. So to conclude, I thought the Fed comments were actually more dovish than hawkish, because the Fed is acknowledging that in the indicators, including economic indicators, inflation indicators, all lagged. And they said they would reassess in December. So I'm not too worried as much as the market participants are really worried. I mean, this reminds me of Jackson Hole, when the Fed equities were rallying until Jerome Powell spoke in Jackson Hole, and he scared everyone. So I'm not too worried. I think everything's going as planned. So just be ready to put your cash, if you have any left, into equities going into 2023. And remember, this is not financial advice. I'm here to entertain you.